respect everybody's time, Barry, including yours and everybody that's joined us so far. So it is 11:03, and Barry, you have been a friend of Momentum Builders since day one, a supporter of Don and I for as long as I could possibly remember, and most importantly, a great friend. And so I thank you for being here today and helping our community, our group, our family understand where we're at today. At least we're post-election now, so things should change. And hopefully there's less fear, or hopefully there's less uncertainty, and things become a little more predictable. So I'm just gonna, like in Toy Story, I'm just gonna pull the string and let you go, buddy.
Well, thank you, brother. I love this group, and I saw Katrina come on before, and we got Sonia, and I see some very friendly names. Really, all of you guys are like friends. As I look through some of the people joining and whatnot, so it's really nice. It's really nice. There's a lot of old time friends that are there, so it's great, and it's good to be with you. So I'm blessed. I feel better. I'm still not out of the woods. I have to actually tomorrow. I begin radiation treatments for 2 weeks, and hopefully that will help do something to the cancer, so that when I start CAR T on December 9th, it helps to weaken it a little bit further. So they drew my cells, which was quite the process, and they're right now, as we speak, programming them to identify. There's a marker in the cancer called CD19, which is specific. So um, hopefully they'll be able to identify and kill this thing, and we can move forward. But I'm very blessed and very grateful that I thank God I feel good. I was able to go through chemo and work the whole time. Look a little different, but it was not easy. But I did the best I could to stay strong and stay optimistic.
Well, I love
So
that what you described, Barry, is something that possibly 20 years ago would have never been possible. And so it sounds like technology is definitely in a place where it can help you today.
yeah, because it would not have been. Yes, you would have to do like a bone marrow transplant and things like that. So CAR T is, it's not going to be easy. So I've got to be monitored for the first 2 weeks afterwards. But you know me, if I can, I'll get on the updates and stuff like that too.
We know
I
you
can't stay
will.
away. I can't stay away,
Yeah, yeah.
um, because I love you guys and I love what I do. So, all right, let's talk a little bit. So rates have been uncooperative. 10-year Treasury is uncooperative, and Gino and I were just talking about, why is that happening? We started to see some really good progress, and you see the needle move right away. Right back in August, we had a lousy jobs report, and man, we get a nice little rally in the bond market, but it was very short lived. And then around, I don't know, September 10th to the 22nd or so, we had almost 2 weeks where rates started to look really good again. And then what happens? We get a funky jobs report, but it was much better than market estimates. And I say funky because I'm just gonna say it. I don't believe, I don't have a lot of confidence in a lot of my dear friends who are really close to it as well. They don't have a lot of, heck, the Fed doesn't have confidence. So don't take my word for it. The Fed said, Jerome Powell came out and said that some of the numbers have been less reliable. So they're looking past at the Fed. The Fed would not be continuously cutting rates if they believe the BLS. The BLS is not reliable. And, whether you want to say it's something, that is with the election or not, wanted to try and boost up the incumbent. I can't tell you for sure. There's a lot of people who believe that. A lot of people who think that. I'm very, very friendly. I'm a member at Mar-a-Lago. I'm close to the people there. Had dinner with Roger Stone the other night and Cash Patel. I mean, think about I was with Matt Gates the other day and, chatting with him, and got a chance to meet Elon Musk and the president at dinner a couple of nights ago. So, I am in circles where I'm privy to a little bit of an understanding of some of the things. And there's a lot of dirty tricks that get played, and I'm not saying it's one-sided. I'm just saying that it's a tough business. So would I be shocked if the BLS was perhaps taking liberties? I wouldn't be shocked at all, especially given what we see. But bringing it down to a business standpoint, the BLS's numbers that they really could take liberties with is something called the seasonal adjustment. And to explain that to you, you were mentioning it earlier, Gino, like, this is the holiday season, right? So, um, there's an abundance of hiring that takes place, September, October. And, you think about just the announcements. These are just from Challenger Gray and Christmas. They tell you the announcements. Amazon, 250,000 people. Target was one store, was 100,000. But how about the other stores? How about the other departments? So what's Macy's hiring? FedEx, um, 50,000 people. UPS, 125,000 people. So, I mean, these are significant numbers. Now, the BLS should, from history, know that all these hirings at this point in time doesn't mean that the economy has suddenly kicked up a gear. And by the same token, in January, when these people no longer will be employed, the decline in employment doesn't mean the economy is in bad shape. I've seen these BLS do a 3 million seasonal adjustment in January. So they're trying to make the numbers more indicative of what's going on in the economy instead of making it look like the economy is, suddenly exploding and almost we're in a depression. They use something called a seasonal adjustment to say we anticipate these types of fluctuations. And when we adjust them down for those seasonal hires and adjust it up for the seasonal fires, even teachers, they um, in June, they are on payroll, but they're not getting a check. And when they come back to work in August or September, now they're getting a check. It shouldn't be a wide swing in what these numbers are showing. So seasonal adjustments do that. This is all to say that in the last couple of reports, what they did was something they hadn't done in 48 years in seasonal adjustments, and they completely gave a much more generous seasonal adjustment than they have done in 48 years, and double the seasonal adjustment that they did last year. So it makes a big difference in the numbers that we get. Here's the point, though, is that by the end of the year, the raw numbers and the seasonal adjusted numbers have to match at the end of the year. You can adjust them during the year and say, okay, it's this and that. But then at the end of the year, the seasons match up and you're done now, right? So at the end of the year, they have to equal the same. So if they did take some liberties with the seasonal adjustments, then the amount of job creation numbers should be reflective of softness that the bond market should like. And you started to see that last month when only 12,000 jobs were created. I should have said that earlier this month. The problem was we had the unemployment rate, which remained very low at 4.1%, and we have some inflation numbers that showed a bit of persistence in inflation. And then you have what really caused the spike this month in the bond market was when it looked like Trump was going to be elected. Um, People will say that it's because they think that his policies will be inflationary. I don't necessarily think that that was the main cause. And it's because if you think about it logically, we had 4 years of Trump, we had no inflation, right? So why would it be? Why? What's would he spend? Would he do this? Yeah, of course. But why would we suddenly see like crazy inflation? We had 4 years of not. And if you believe Vivek and if you believe Elon and their Doge, the Department of efficiency there, right, of government efficiency, um, then there's a possibility. The numbers I heard is that you take like $1 trillion of build back better and things of that nature, and really try to reduce the deficit, which is what also the bond market doesn't like. So the bond market may like it, but when we look at the real reason I think that money has come out of the bond market is because it's gone into the stock market and risk on assets. I mean, has anybody taken a look at Ethereum and Bitcoin? Has anybody taken a look at what the S&P and the Nasdaq and the Dow have done? I mean, it's not just the bond market; it's gold. So why would gold be taking a hit after such a nice run up? It's not a coincidence that you have the risk safe assets like bonds, like gold, taking a hit. And now, because there's a presumed, well, there's going to be less regulation, maybe the economy starts to take off, this money goes into the stock market. And hey, if you're a fund manager, you're going to want to chase some of those potential returns. So I'm going to take my money out of the safe, kind of boring 5% return, 4% return in bonds, and put that into where I can make a lot more money. So that's what I think has been going on. So that's the answer to that first question.
Yeah,
But
I
let's
definitely think that's one of the things that I've been thinking about is people have confidence in those risk-based assets, and they're going to seek now an 8% return or a 9% return, and you're just not going to get that in bonds. And so I think people have been held back for a long time, and they're just kind of excited to see assets potentially grow again.
Well, thanks. So I've got some slides I'm going to share with you. I want to get on some stuff, but I just wanted to tell you guys that thank you for the very kind, very, very kind remarks. So I appreciate that more than you know. Appreciate that, guys. So let's go share some slides here. And um, well, we don't want to see that one, right? We want to see where are we? I had the slides up, guys. I had them. Did I? Well, let me try this. Let me try this again, team. Let me just I had them up and I must have gotten all excited and clicked out of it. But go ahead, ask me another question while I go back and pull that together.
Yeah, I mean, look, I have quite a few friends that are heavy into crypto,
Yes.
and I know it's exciting right now, but I've also gone to sleep one night and woken up the next morning to crypto being 50% down overnight. So I warn all of them. I'm saying, look, man, this is a great run up. It's an incredibly volatile instrument. I do think it's real money that's being traded, but it's definitely something that needs to proceed with caution. So I don't think that's necessarily a long-standing run up that's going to just hold and continue to grow. Those are very volatile assets, and people might get in and out very quickly.
I've always been a believer in crypto. I mean, I don't know if you guys remember, but back, with MBS Highway, I was a big proponent of it, and did some webinars on it back in 2016 and 2017. So I've always been a big believer that there's a place for it, but you could make an argument that has it gotten over its skis a little bit, potentially. But the market can remain irrational longer than we can remain solvent, right? It's an old saying that could hold could hold true. But anyway, let's take a quick look here at the Fed, interest rates, housing. So I'm going to go fast here with you guys. Okay. So first, I think everybody likes this. Is where do I stand with my production? And where does the rest of the industry? So we have the best data on this, and right now there's 152,000 LOs in the industry. That's 80,000 less than we were a year ago. So think about that, guys. That's a big change, and congratulations to you. So the median number, which means 76,000 did more, 76,000 did less in volume in the last 12 months, was $4.5 million. That's half the originators did less than that in the past 12 months. That's pretty sobering. You want to be in the top 25%. If you closed 10.9 million or more, you're in the top 25% in the US. And if you did 21 million, you're in the top 10%. And I know a lot of you on this call are at these rankings. Top 5%, 31 million in the past 12 months, and top 1%, 64 million. You're in the top 1% in the United States. So my job today is to kind of go over some stuff with you and see if we can get you guys, wherever you are, into the upper echelon of originators. So let's start with the fastest way to make more money. So I do a lot of work with Tony Robbins, who has become a very close friend, and I do his Lions group at his home for his top 50 clients in the world, and then I do his platinum and his wealth creation too, and I do his Fiji group. And the one thing that's a basic tenet is that most people are salespeople are looking to increase income, just like all of you are. So what's the fastest way to increase your income? Here's the secret. This is what we agree on 100%, and it's just close more of the opportunities you already have. It's that simple. Don't spend more money necessarily. Don't work harder. Don't do it. Just, I mean, do all those things, yes, but just take the ones that are in your hand and close more of them, and your income goes up without you doing anything else but closing them. So how do you do that? Okay, so now that we know that's the secret, how do we get to that goal? Well, the magic formula for this is to gain their trust. That's everything. You think about all the bullshit that you go through at the airport, or compliance, or you'll remember in all your freaking passwords, right? And all the stuff that goes on. It's all because there's a lack of trust, because there's a lot of bad actors out there. And what about in a personal relationship? I mean, heck, what about a love relationship? Have you all been there where I've been there, where there has not been trust in the relationship, and the relationship is hard. It gets toxic. I think we've all in our lifetime potentially been there. Um, but conversely, how beautiful is it when you trust each other? I mean, how fast do things happen? How How smooth is it? How incredible is it? Whether it's a family member, a love relationship, business relationship, when there's trust, it's a whole different ball game. So, okay, what are the best ways to gain trust? So, I believe the two um, best ways to gain trust is one is going to be vulnerability. That's hard because your head gets in the way, your ego gets in the way of vulnerability. I don't want to appear weak, and then there's fear because being vulnerable means that you're now talking about things that could put the relationship potentially at risk, is what we think. But it actually does the opposite. So, you know, a real estate agent who shows somebody homes and every home they look at is just selling feature, feature, feature. Look at this, look at that. Look at, oh my gosh, look at the bedroom, look at the new appliances, look at that isn't going to gain any trust and the client's guard is going to be up. But think about the real estate agent who's maybe shows the features and talks about the features positively as they should. But what they also do is they point out some things that they need to watch out for. Hey, that roof doesn't look like it's going to be good. I would check some of these appliances look old, or the flooring definitely needs to you should consider that because flooring doesn't look good, or whatever it is. The negatives make the relationship transform from a salesperson to an advisor, and you go from opposite ends of the table to metaphorically now sitting on the same side of the table and looking at the transaction together. I mean, that's the whole ball of wax there, team. And from a mortgage perspective, just to think of one off the top of my head, buy versus rent kind of analysis. Everybody's talking about all the positives of buying because we want them to buy, the realtor, the mortgage professional. But what if you said, hey, a couple of things you should think about renting? First of all, the cost to buy and the cost to sell, well, as good as buying is, it's going to be tough to recoup those if you're in that home for like less than a year and a half. I could do an analysis for you, but probably better off renting if you're going to be there less than a year and a half. And a couple of other things you should think about too is that be prepared because on a purchase tax is going to go up maybe 2% a year on average. Maybe you're going to have repair costs that you would have had paid for if you were a renter. And if it comes time to sell, then it's going to be some fee that you're likely to pay, 3% or so, but there's going to be a fee you're going to have to pay at time to sell. So just want you to think about those things. And then when you tell them all the great things about buying, you're doing it in a way that gains their trust. Then they're going to listen to you when you talk about appreciation, when you talk about the tax benefit, when you talk about the equity buildup, when you talk about the fact that your payment's fixed, but that rent goes up every year. And now you could start to see the payment change and that the principal portion does not count as a negative. These are this is the cream of the crop. The people who interact with their customer at that level, they're gaining trust. And the other is with knowledge. You will definitely pay for knowledge and wisdom. You're not going to pay for information, right? That's what you have to understand. You're in the information business, you're in the wisdom business. You really have to have an honest conversation with yourself because this thing and AI and now believe me, I'm an expert on it. I wear it out. I actually have gone to the max. I've gone to my limit like so many times as I tried to learn about cancer. Team, I can tell you, I swear on my life, every single physician that I speak to, and I speak to a lot of them, every single one asks me if I'm a doctor because I went from knowing nothing in February when I was diagnosed to trying to truly become an expert. And you can do the same thing in the financial world. If I asked you guys, what business are you in? Are you in healthcare? Are you in, entertainment? Construction? The business you're in is financial. So you need to be a financial expert. So if I were to ask you, what's the most important price in the financial world? What is it? Do you know? And just think about that. What's the most important price in the financial world? So the world, we're talking about money. U.S. is the reserve currency. So what's the cost of money? Well, that's the Fed funds rate because that's the cost that banks pay to each other in order to distribute the money around the country. And how many of you know what the Fed funds rate? You want to just have some fun. What's the Fed funds rate, by the way, team? Just pop it in. Don't look it up, okay? Because that cheapens this, okay? Do you know it off the top of your head? If you do, put it in there. If you want to take a guess, fine. Um, that's fine. If you get it right, you get it great. If you don't get it right, who cares? We're family here, so it doesn't matter. So um, I see somebody put it in correctly at 4.625. So you are correct. And by the way, if you said 4.5 to 4.75, great. You're in the range because it's 4.625. So we should know this, right? This is if we want to be the very best that we could be, we have to be able to know this and understand it because it's the building block for everything. So if it's 4.625 is the Fed funds rate, right? So what's going to govern the Fed funds rate? So the Fed is going to determine that based on two things. They got a dual mandate. So the first one is inflation. They want inflation to be at 2%, and they measure it based on what? What is the Fed's favorite measure of inflation? Anybody want to tell me that? You could pop it in there. Again, if you get it right, you get it right. If you don't get it right, don't worry about it. We're all going to, at the end of this, we're all going to know. Um, and so many of you are putting in PCE, and I'm so proud of you, and that's correct. But take it one step further. What PCE? Who can tell me? Core PCE. Bingo. Josh, yay. My good friend Josh. Yeah, core PCE. Of course, Josh, you got it. But it's important that we know this. So what is core? Core means they take away food prices and energy prices because the Fed's not going to have an influence on the weather, which is going to potentially cause food inflation if we have nasty weather. And the Fed can cut rates, but it's not going to help the weather. And if something goes on with OPEC and it forces energy prices higher or lower, well, the Fed can't cut or hike their way into balancing that out. So the Fed says, hey, we can't control food and energy. So let's look at the core. And that's what we're going to have influence on. So we want core inflation as measured by PCE to be 2%. And anybody know what it is right now? Anybody know what the core PCE is? Want to take a guess? Because these are numbers we should know. And from today on, please make sure you know them, okay? Because that's the deal. Got to know this stuff. And I'll show you why in a minute. You guys are close. You're in the neighborhood, so that's good. You guys are good. So the media will tell you it's 2.7 on core PCE. The decimal number is 2.65 rounded to 2.7. So let's say 2.7%. So the Fed wants it at 2. So why is the Fed cutting rates if they want this at 2? It's because the Fed looks at things too, like the 6-month and the 3-month run rate, and they're trending close to like 2.3%. But they also know that an important part of core PC, it's about 18% of it, is shelter costs. And shelter is measured by rents and something called owner's equivalent rent. And the way that the BLS looks at it, it has a tremendous lag. They like go back to neighborhoods and markets every 6 months. So you could be seeing declines that are not captured. And if you take a look at something like ICE, or if you take a look at CoreLogic, we're seeing rents go up at like 2.9% a year. And that's blended. You have about half of them, a little more than half are renewals. They're going up about 5% a year. And then you have new rents. Well, new rents aren't going to go up as much because the landlord doesn't have anybody in there. So the landlord's going to say, hey, look, it's just, I'm getting zero. So come on in. They're actually going down year over year by 0.7%. So you blend them together, you get 2.9. The reason renewal rents go up 5% a year or so is because landlords are smart. They say, hey, look, I know it's a pain in the ass to move. And I also know that it's expensive to move. So I could probably push you 5%. You'll probably tolerate that rather than the hassle of moving and rather than, paying the expense of moving. So that's why you see the renewal rents going up like that. So it's 2.9. But in the Fed's numbers, it says 4.9. So you take that differential between the two, and PC is really, really closer to 2.2% or 2.3% in that neighborhood. And I think the Fed is getting smarter, and the Fed's starting to realize that. So that's why the Fed's continuing to cut. They're going to cut again December 18th. And the other thing is because they don't believe the stuff that's coming out of the BLS, which is the second part of the Fed's mandate, which is maximum employment. So maximum employment as, oh, here it is. You know what? I did these numbers for you. I said them, but I forgot to show it on the screen. So the 12-month run rate is 2.7%. It's really 2.65, like I said, but we rounded 2.7. 6 months, it's 2.3. So, it's the trend is lower. And without the shelter leg, it's actually 2.2. So team, this is why the Fed is going to continue to cut. But the second part of the mandate is, what's the current unemployment rate? Anybody know? Come on, tell me real quick in the chat window there what the current unemployment rate is. Oh, look at you guys. I'm proud of you guys. I'm proud of you guys. You got it. It's 4.1%. Very good, team. Yeah, you got it. Okay. So listen, if you didn't get it right, who cares? But from now on, know that, because this is a very important statistic that the Fed is looking at. And the Fed's using the unemployment rate right now, even more importantly than inflation, as its guide to if they're going to continue to cut rates. So why is that so important that they cut rates? So, with the unemployment rate at 4.1%, they're afraid that it's going to go up. And by the way, when you decimalize it, it's really as close as it could get without going to 4.2%. That's why I'm saying the BLS, it wouldn't surprise me if there's some stuff going on. Just they shave these numbers too close. It's too I don't know, the coincidence of this happening, I don't know. It's just unreliable. Well, anyway, here's the latest statement of economic projections. We're going to get another one on December 18th. And at the last one, the Fed members essentially said that we're gonna have two cuts, one in November, one in December. And they did the one in November, and they're going to do the one in December. So unless we get something shocking on the November jobs report, which we'll get the first week of December, if we get something shocking, things could change. But other than that, they're going to cut again December 18th. But look what they're going to do in 2025. They've told us they're going to cut another, let's say, 100 basis points, maybe more. A lot of them say 125 in December. So why is that so important? Because this is the building blocks for everything. As the Fed cuts rates, I mean, look, think about it like this, right? You're a pretty savvy investor yourself, or maybe you can put yourself in the position of imagining you were a fund manager, and you're searching for yield. So for a long time, you were getting a very attractive yield in money markets, which is going to closely follow the Fed funds rate. So you were getting something around 5% in a money market for a long time when the Fed funds rate was 5.375. The 10-year Treasury at the time was around 4%. So, man, I'm getting more in a money market than I am in 10-year Treasury. So why should I buy 10-year Treasuries? And then when the Fed cut, it brought money markets down to, let's say, 4.5, because the Fed cut the Fed funds rate to 5 3/8 to 4 7/8. Money markets are paying about 4.5%. So at 4.5%, you're still above the 10-year Treasury. No need to make a move, but they just cut again. So now you're getting like 4.25, right? Probably the end of the year, December 18th, not that long, not that far away, a month from now, you'd be getting closer to 4. So if you're getting 4, and I'm looking at the 10-year Treasury, and I'm saying, boy, I get 440 at the 10-year Treasury. And now if the Fed's going to cut another 100 basis points next year, I'll be getting 3. Why don't I lock in that 4%? So you should start to see, if the numbers cooperate, a good rally in the bond market. You should see the 10-year Treasury start to cooperate if we start to get the job numbers that I think we'll get, and inflation starts to just have a less fearful tone to it. It's all out there for us. So where would we go? I think 3.6% on the 10-year would kind of match a range that we've been in. Here's like 3.7, 3.6. So in 2024, we were here a couple of times, and then we were down by 3.6 a couple of times. I think that we could match those numbers, just if you were looking at it from a technical analysis standpoint. I think that's a realistic target. So if we got a target at 3.6, that's the 10-year. So what about mortgage rates? So mortgage rates are going to ride above that. Well, the question is how much above it? If you look at history, history tells us for the last 40 years or so that the predominant range is between 1.6 and 2%. They've been about that level 85% of the time. But then you got the great financial crisis, you got COVID, that causes disruption. And you got the Fed going wild here. The Fed went wild here. So when you get the quantitative easings here that happen, it creates disturbances in the market, and it creates these fluctuations that are abnormal. This is more of a normal range. So what is causing this? Why is this happening? So let's talk for a minute. So I'm going to take you someplace a little bit deeper, but I know you can handle it. So everybody talks about the spread, but they have no freaking clue what it means or why. So I'm going to explain to you, so you're going to know more than the 99% of people out there. We all know the basics, right? As let me pull this up here so you could see it. I'm going to pull up a mortgage-backed securities here. So here's the price, okay? So if this price were getting better, if it was green, if it's going up, what's happening to your rates, everybody? Your rates are getting worse, right? Going down. I'm sorry. Pardon me. Your rates are getting better. They're going down. Forgive me. If the price is going down, rates are going up, right? When you see this red,
Yeah, I'm
you're getting
sorry to
worse
interrupt,
rates.
but we don't have a slide up.
Oh, you can't see it.
We
But you were seeing this though, right?
were seeing the other stuff. Yeah.
Okay. All right. So fine. You were not seeing that because of my mistake once again. So let me share that. Okay.
Ta-da.
So here we go. Can you see that now?
Yep.
Okay. So sorry, guys. So when you see this, and you guys are familiar with this, when this is all red, that's bad. Its price is going down, rates are going up. When this is green, prices are going up and rates are going down. So you understand that relationship, right? That kind of seesaw that there is, right? So the better the price, the lower the rate. We get that. Yes? Okay. So part of the price of a mortgage, it's interesting, is servicing. Why? Because nobody holds a mortgage. The company you make your payment to, they don't hold it. It's sold. It's an asset. You know who owns it? Me and you. We have it in our 401ks, our IRAs, our mutual funds, retirement plans. We own the asset, but we're not going to collect payments from the customer. We're not going to, send them a nasty note if they're late or answer their questions or pay the real estate taxes. No. So what does the ownership do? We hire somebody to do that, called a servicer. Because what do? They service the loan. So they collect the payments, they pay the taxes, the insurance, answer the questions, all that stuff. And for that, they get a fee. So it's not a flat fee because some mortgages might be on the books longer than others. So when do we pay the fee? We pay the fee at time of closing. And we have to guess how much work they're going to do. So if rates are 3%, chances are that that mortgage is going to be on the books for a long time, which means that they're going to have a lot of work to do, which means we have to pay them more. So because we pay them more, the price of the mortgage asset itself goes up and the yield relative to the 10-year Treasury comes down. So you have a shorter spread. But what if rates are at 8% like they were a year ago? At 8%, what happens? Is that loan going to be on the books for a long time? So I'm not going to pay you a lot of servicing. I'm going to pay you very little, which means the price of the deal when it closes is less service release premium, which means to compensate, the rate has to go up. It's that simple. So relative to the 10 years, so let me show you this in action. So here we go. Let's go once again, and let's pull this back up on the slide. So here, we didn't know what was going to happen with COVID, but then rates came way down. Here's your 3% mortgage rate area. So you're going to have to do a lot of work. So you're going to get paid a lot of money in servicing, which means the spread was only like 1.4% or so above the 10-year Treasury. But here it went up to 3% because this was 8% rates. 10-year Treasury was at 5, mortgage rates were at 8.1. Notice they've been coming down, and it's currently around 2.5%. Now, do I think it'll get between 1.6 and 2? Not really. But why, by the way, has it come down? It's come down because, a 6.5 or 7% mortgage has less propensity to refinance than a 8% mortgage. Now, as it comes down a little bit more, then you will see this come down a little bit more. So let's have some fun. So where can mortgage rates go in the next 6 months? Well, I think if you look at technical analysis, the 10-year Treasury, based upon what we're seeing potentially from the employment reports, from inflation, I think 3.6 is a reasonable target. And then now let me ask you guys. So I just asked you the question before, right? And I said, okay, so we were at 3.1 last year. It's come down to 2.5. If rates come down a little bit more, where do you think that the spread would be? You want to put it in there? Your guess? What do you guys think? I'm going to ask you here. I want your help. All right. So I like, well, now remember, seeing a spread of 1.6 to 2%, it's probably rates that would be closer to 5% or less, right? So, Josh has a good number here, I think, at 2.25. So let's go with Josh's number 2.25 because we're 2.5 now. So if we had 2.25 to this, then we're at 5.875 is a good forecasted rate. So between 5.75 and 5.875 in the next 6 months. Now, could we be wrong? Of course we could. But there's a difference between pulling a number out of your ass and really doing the work that is reasonable, that you will hit these targets more than you will miss them. Okay. You're not going to hit them 100%, but it seems like a reasonable place that rates could go. So what does your business look like if rates get to 5.875, right? I mean, just think about that. So we talked about trust and how important that is. So let's go back to that for a minute. Now, the fastest way to increase your income is just close more of the deals you have, and you want to do that by gaining trust. Vulnerability is one, but the other is knowledge and wisdom, right? Because people pay for that. So phone calls made from a customer to a mortgage professional, and the first mortgage professional answers the phone, and they're asked the question that you and I got asked every single time we spoke to a client, that you still do for 23 years as a mortgage professional. Every single one of my customers asked me, is this a good time to buy? How's the housing market? Where are rates headed, right? This is what they ask. Every single one of them, right? You ever have a customer say, where it says right there, I don't care, just fill in whatever you want? We all know that. So this is the questions we get every time. So should we be prepared to answer it in the most effective way that's going to gain trust, that's going to increase our income the fastest? So how do we gain trust with wisdom here? Because we've been just handed an opportunity. So the first loan officer says, "Hey, you know what? Market's pretty good right now. It's good. We see prices going up. Seems pretty strong right now. Interest rates. Well, I'll tell you what. If I knew where rates were going, I'd be having a pina colada on the beach somewhere. Ha ha ha." Now, okay, that's an answer that you could give, but did I really gain a lot of trust with that? I mean, think about it, because that's if that's your answer, then let's rethink that. Because after what we just, I don't know, 15, 20 minutes worth of chatting together, um, what if you answered the question like this? And it was, I'm going to give you the script here. So if you want to take some notes, get ready. Okay. Mr. and Mrs. Client, that's a really good question. And it's an important one because a home is potentially one of the largest financial assets that most people make. So it's going to have a bearing on net worth. And right now, um, just like any other asset, home values are going to be dependent on supply and demand. So let's talk about supply first. And one of the things I pride myself on is having a bird's eye view into the supply side. So in your zip code right now, inventory is very, very tight. It's gone up from last year, but man, I'll tell you what, it's about half of where it was pre-COVID, and population's gone up. So we are seeing certainly um, restrictive inventory. That bodes well for future price appreciation, but it's only half the equation. See, the other half is demand, right? So we know supply's tight, but what about demand? Demand is going to be reliant on mortgage rates. And here's the thing, the National Association of Realtors said that across the United States, if rates drop 1%, there's 5 million more people that are eligible buyers. Now, not all of them are going to buy, of course, but think about that in a tight inventory environment. That additional buying comes in, it's going to be very supportive of pricing. So what would cause rates to come down? Well, the first thing is that the Fed has told us so. The Fed's statement of economic projections, and I know we're going to get another one December 18th, but the last one said that, yeah, they're going to cut December 18th by a quarter, and they're going to cut maybe another 1% come 2025. So over the next year or so, could rates come down rather significantly from where they are now? I think there's a really good chance of that. Does it affect the 10-year Treasury directly? It doesn't, but eventually it kind of filters through. So we see the 10-year Treasury coming down, and then mortgage rates right above the 10-year Treasury. So it's quite possible that we could be in a pretty favorable interest rate scenario over the next year, which would increase demand. So to answer your question, I think that this is a pretty good time to buy because you have tight supply, you have likely increasing demand. So I think your decision is a pretty good one. Now that took, I don't know, what, 90 seconds or so. And you asked me who's got a better chance to win that transaction in those 90 seconds. Is it me or is the pina colada boy? Right? I mean, you just think about that. And so it needs to be you. Um, you might be saying to yourself right now, okay, Barry, that's easy for you to do, right? Well, I promise you, when I came out of the womb, and the doctor may have tapped me on the rear end, I did not say, hey, doc, you know what the Fed funds rate is? I promise you that was not the case. These are all learned skills. These are all things that we just get better at. I give you another thing. I did not know, I was kind of ignorant on cancer, but now you ask me anything. So in the last 8 months or so, I have become 9 months now. I've become um, very, very, very knowledgeable. So if I can learn about cancer and understand, you know, all the drugs, what they do, the side effects, how to pronounce them, so much that every time I speak to a physician, he thinks I'm a doctor. That you can do this stuff. This is not hard to do. Will it take a little bit of time? Yeah, but um, the results are dramatic. It's the fastest way to increase your income. So let's go on a little bit more here. So I'm going to try and pick up the pace and go on a little bit more. And I forgot to share with sound because I wanted to share with sound here because I got some stuff coming up with a little sound on it. So I wanted to make sure I did that. All right. So I just told you rates are going to come down. So we tell people marry the home and date the rate, right? So buy the home now and then you exchange the rate for later. So it sounds cute, but we got to prove it for them. So first thing I'd be saying, hey, look, for every 1% drop, 5 million people become more eligible. Higher rates, the buyer's best friend. It's your best friend to buy right now. Tight inventory is going to be tighter. It's going to lead to less choices, and that's going to have upside pricing pressure. Let me just show you how much. So $700,000 home, 80 LTV. Here's your rate. Here's your payment. If you waited a year in your zip code, I've got really good forecasts that show in your zip code what it is and happens to be. I want some conservative, 4.1% here. So that means an ADLTV would be a higher loan amount, but because the rate's so much lower, the payment's less. In fact, if you bought today, you would still have to carry a mortgage payment that's $182 more than if you waited a year. So if you carried it for a year, 182 times 12 is 2184. So that's dating the rate. But now you want to swap the rate, right, for a lower one, you got to pay for that. That's cost to refinance, the dating agency. That's $3,500. So how much does it cost to date the rate? 5684. It's called $5,700, almost $6,000. It's an expensive date. But what nobody looks at is that 4.1% appreciation on $700,000 is $28,700, Dean. So you take the benefit minus the cost, and you have $23,000 is why you should marry the home and date the rate. It's not just a cute saying if you show them. And here's where you drop the mic. And then you show this to your realtor. I speak to a lot of realtors. When they see this, I'm telling you, they get so lathered up because nobody else is doing this for them. This is a problem that they have. And people are waiting. They're on the sidelines. They're putting it off. Show your realtor that you can help them. And look, another thing is right now, there is going to be a tremendous refinance opportunity. There's about 6 million loans. If we hit that rate target, there's 6 million loans that will be refi eligible. 6 million. And I'm not giving you the numbers that you get from ICE, which counts everybody before 2022, where there could be some hairy loans. I'm just saying 6 million loans that originated after the spring of 2022 and on. Okay, so these are real chances for you, real opportunities. 6 million loans would be in the money for a refinance. So I'm going to let you in on a secret. As an originator, I was very proud of my numbers. I was number one in the country one year in the entire nation. This was in the 90s. So yes, I know it was way back in the day, but still, my numbers were really good. I always averaged $100 million a year in my career. And a secret to that was was that I established a strike rate with every customer. And that actually helped me get the initial sale. Like I would say, hey, look, one of the reasons why you need to do business with us is because we're going to monitor your loan and we're going to notify. So it's not just the rate today. See, here's the way I would sell. So it's important what the rate is today. And I understand the competitor may have a lower rate today, but that's today. The rate you close with is even more important, isn't it? And I am going to show you how I monitor the market, and I will be able to illustrate to you how I will watch it for you and try and capture the lowest rate, which might be lower than what you're getting today from a competitor who is going to lock you in today. In addition to that, I'm going to watch this loan for you like a hawk after you close. And we're going to establish a strike rate right now because you see these opportunities are very fleeting. Let's go back to August 5th. We had rates that were low for a few days, then they jumped back up 1%. Back in September, third week of September, we had rates drop very low, and then they moved up like 1.25%, maybe more. So we want to take advantage of those opportunities because if you're asleep at the wheel, these things don't happen. And that's why you want to work with me. So let's right now establish a strike rate. And if we're going to figure out an amount you're going to save, let's call it $350 a month. That means you're going to save $4,200 a year or $21,000 over a 5-year period. So when I call you and tell you that you've hit your strike rate, I want your permission and your commitment that I can go ahead and lock you in and grab that so we don't lose that opportunity. And listen, this is the thing that has helped me make literally not millions in production, millions in income over my career, millions and millions of dollars in income because I just refinanced everybody and did it on the strike rate. So as technology allowed us and we gathered information at MBS Highway, we put it in as a tool for free for you guys as a member of MBS Highway. And I already know every single client you've closed. I know their loan amount. I know the date. I know the loan type. So I've got all that data. We have everything. Interest rate that they have, this is a little bit, hit or miss, but we have good estimates for that. But what you could do is you just go in the tab in MBS Highway and just spend 15 minutes and put all their interest rates in. Now up here, what you get is you get all the default numbers. So every day we'll tell you what the market interest rates are. And then we know that there's EPOs out there. So we have 6 months as a typical EPO. Now, if there's a 6-month EPO, you could change this, okay? But if there's a 6-month EPO, we will notify you after 5 months of closing. So if they close in a month, we're not going to tell you, hey, go refinance them. But if it closed more than 5 months, then we'll tell you, go get them because we know that it'll take roughly a month and they'll be out of EPO by the time they close. Now, when are you going to get alerted from us? If their loan is below 350, you could change this, but I think it needs at least 0.75% benefit. 350 to 766 jumbo, I think 0.5% is what you need. And above jumbo, 0.3%, it starts to get sexy to refinance. So these are the levels, but these are editable. You can change and put whatever you want. And then if somebody hits it, like I anticipate a lot of your clients will in the next 6 months, you get this little email every morning at 10 a.m. Say, here's your customer. This is the loan amount. This is their target. They're going to save this amount of money every month. So bingo, you have it. This is very easy to do. But I'm also experienced enough, and I know that you call the customer up, and once in a while you're going to get somebody that says, I know, we get 7% is what I'm living with. It hits 6.25. I could save $260 a month, but boy, if it goes another eighth, I could save $300 a month, right? Maybe I should wait. Mr. and Mrs. Client, yes, it is true that if you want an additional eighth, $32 a month, yeah, you're almost at $300 a month. Yeah, it's true. But what if you're wrong, right? And it doesn't happen. Or better yet, what if you're right and it takes 3 months? Look, we're right now way above where we were on August 5th when you had that opportunity. So it's more than 3 months, right? And if you miss that window, you still haven't hit it. So think about it. If it takes 3 months for rates to decline, which there's no guarantee, what happens if you've waited those 3 months? You lose $260 a month while you're waiting. So 3 months times 260 is 780, right? That you would totally lose. Divided by the $32 a month, it would take until the 25th month to break even. And we created a tool for you, an MBS Highway, to do that. And it doesn't even count the delay period of waiting 3 months. So it's going to take you 28 months, if you're right, to get $30 a month. Does that make sense? Because here's the thing. In that time frame, there's an opportunity likely that rates will have gone lower, and I'll just refinance you again and get something better for you. So why lose the opportunity? And that's what's really important. Another big thing here is that you have a lot of clients that are hesitant to move up, even though they need to move up. They've had a kid, the kid's sleeping in their bedroom, ruining their intimacy. They got work from home, but it's not work from home because they don't have an office in the home. So it's work from Starbucks. They've got the need for a garage. They've got the need for a backyard, whatever it is. And yet they say, well, you know what? I'm at, 3.25 and I need that home, but the upsell in the home and the upsell in rate to whatever it is, 7% or so, it's just too much of a monthly payment differential. Mr. and Mrs. Client, it's true that you got a 3.25% rate, but that's only on your mortgage. Do you have any debt? Yes, I do have debt. Well, yeah, it's America. We are more indebted than we've ever been in our history. And if you add your car loan in and blend the rate, so you allocate this lower amount into the total times this, and then you take your credit cards, you take your store credit cards, you're really at a blended rate of 6.5%. It's not an average rate, it's a blended rate. So this is accurately what you're paying. So what most people do is they sell their home and they think they got to take all the proceeds and use it as down payment on the new home, but you don't have to. There's no tax consequence for that. So what if you sold your home, take some of the proceeds, eradicate all these debts, and then you take the remainder and you use it for your down payment? So it means a bigger mortgage. Yep, bigger mortgage payment, but you don't have the other payments. And you know what? When you take your total monthly payment you're paying now versus what you're paying on a go-forward basis by using this strategy, a lot of times the payment goes down, or the payment goes up a minuscule amount or a manageable amount. It's not the payment shock, and you get what you want. You get your bedroom back. This is what people want. So NAR lawsuit, there's a big twist here. I'm going to go quick here, but you remember Josh Sitzer, that little son of a gun? He started that whole thing. But you know what else he did? Talk about being devious. He started Landian to compete with realtors. And boy, I'll tell you what, your realtors need you more than ever. I want to play the commercial for you. Just give me a thumbs up, Gino, if you hear the sound.
But what you don't realize is that you may be seconds away from a very costly mistake. Under new 2024 laws, sellers are no longer paying buyer's agent commissions like they used to. So that agent, the one your friend introduced, he'll put you at a major disadvantage. Either he'll make you pay him a 3% commission out of pocket, or he'll put the whole deal at risk by asking the seller to pay him. Listen carefully, because there's 2 ways to avoid this disaster. One way is by calling the listing agent and telling them you're unrepresented. But since unrepresented buyers are typically harder to work with, just getting a listing agent to give you a tour or to read your offer can be really frustrating. The new smart way to buy is with a Landian low-cost buyer's agent. Just go to Landian.co Paste the listing link, and within seconds, you've got a tour or an offer prep session scheduled. You'll save a lot with Landian by avoiding the 3% that other agents charge. With the flat fee at closing option, you'll save over $13,000 on a typical $500,000 home. And if you pay up front, you'll save even more.
So if that pissed you off, imagine what it does to a realtor. They go to the Landian.com site, you can pull it up, it's right there. So what is this telling us? It tells 80% of realtors are buy-side agents. They're going to have a hard time going forward. So you got to help them. You've got to create value. You've got to be able to articulate the realtor's value. So what would I be doing? I'd be going to my buyer's agents. I'd be saying, hey, listen, one of the things that is changing right now is that as you know, the cooperative compensation agreement is no longer something that is going to be out there. And a lot of buyers, especially when you look at these Landian things, they're going to be looking for discounts. And so we have to articulate why you're better than Landian. We have to do that. And let me do that for you. Let's go back. And if you're going to charge a 3% buyer's fee, let's go back and look at all the transactions in the past that we've done where your negotiating skills help knock more than 3% off the purchase price, where you've dissected the home inspection and save people thousands and thousands of dollars. You're the quarterback. You know the schools. You are going to help them with moving. You're going to help them with utilities. You're going to help them with everything. Landian is not going to do that. And let me explain how vital of a role you play. So can we do that together every time you meet with a customer? And let's help them, because you need to be helping them so they can keep feeding you business. But now you can really use this chaos to lock this in. The other thing is 20% of agents are listing agents, but they're going to have a lot more power. It's almost going to be like going to like a car dealership and saying, hey, what inventory do you have? Listing agents going to be looked at for the inventory that they have. So you need to get more listing agents. You need to have these
But what you don't
presentations. And one of the things that really helps you with this is, I just got to tell you, List Reports is really, really good at this. We will give you a lot of intel on buyer side and listing side agents, show you what they do, where they are, who they're working with, if they're cheating on you, give them all kinds of marketing material. Because I tell you what, a lot of them are going to really need your help right now. There are so many tools that are within here that are helpful, and pieces that are helpful. I think that it's almost like too easy to just click something and provide a listing agent who's about to get fired because their home's been on the market 150 days and they haven't sold it yet, to in one click help them. I know that I saw Josh on here, and Josh, who's incredible, has explained to me that this is something that is a tool that he uses to use this with listing agents. So team, this is something that I believe is one of the easiest ways to move forward. And there's something else that we have that I think is very effective, and it's called Home Report. Um, there's a tool that's similar to it, which is HomeBot, and HomeBot's a great tool. Don't get me wrong, it's fantastic. And this does a lot of the things that HomeBot does, maybe a little bit different. Maybe they do some things a little better. Maybe we do things a little better, but we're going to give people every month their home value forecast. We'll give them savings calculators. We're going to show them how they could pull equity out of their home to do things. We're also going to show them homes on the market and give them some opportunities. Everybody's nosy. They want to know what's out there. So this is something that people could do. You know, my dear friend, Tim Brahim, who's such a great, great coach. He is so amazing at putting together presentations. If you're not connected to him, you really should be, at Loan Atlas. I think that his scripts and coaching are absolutely incredible for how you can use this moment in time to really solidify and gain new realtor relationships. And by the way, this is something that will also help, because you can build your database. Unlike HomeBot, we don't charge the realtor. Unlike HomeBot, we don't limit you on your contacts. But you also have this where, people are saying, hey, where are you getting your home value every month? Where are you getting these forecasts? Yeah. Oh, yeah, here. Put your name in here. And Barry will send this to you too. Look at this guy with all this hair. Wow. That screenshot's a little older. But MBS Highway, if you're not on it, all the stuff we talked about today, it's all in there for you. But, here's something that I would be having a discussion with every single one of my customers. And let me just show you how we've been managing the market for you. Some people say, well, I lock all the transactions I get. I think that's a mistake, guys. I think that's short-sighted, and it doesn't make you an advisor, it makes you a robot. So let's go back to June 28th. As you notice here, the market was kind of flat. And before prices got a lot worse, this is pricing, we issued a lock. It saved 113 basis points. But then there's patience there. We told you to float for how long? 35 consecutive days. Doesn't mean the market went up for 35 days. Look at how bad it went down here. But we were patient enough to understand that there was support levels here. So what happened was we saw prices go up, 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 and we issued a lock on August 5th at the exact peak of the market. So we gained 35 days time, so better pricing options. We gained 309 basis points, and then we saved 99 basis points in the next 4 days on the way down. Then we told you to float for how long? 48 days. We told you to float. And during that period, there was some turbulence here, but we told you to float during that time. And what happened? Well, we saw prices get better, better, better. We gained 125 basis points there. And then we had all those locks that we did here before the bottom fell out. And we had the lock before that jobs number because we thought it was going to be a little fishy. And sure enough, it caused problems. And now we've gone through a lot. We've saved about 238 basis points. So this is what we want to do. And listen, as far as tools that can help you with presentations, again, another great tool is Mortgage Coach. They're terrific. But I think that, we do make presentations really effectively with the tools that we have. Our loan comparison tool, people tell us that it's the easiest one on the market. And of course, you can create videos with it. It's really good stuff. It's all on MBS Highway. So, this is kind of what it looks like here. You can present all this with just a click. It's so easy. So 4.5 million is the median. So, 76,000 did more, 76,000 did less. But MBS Highway subscribers do more than double that. If you think about the difference between the two, it's $46,000 a year. If you add list reports, it's $60,000 a year. So 85 of the top 100 originators in Scotsman's Guide are subscribers. Maybe there's a correlation, guys. If you want to get it, we got a deal for Momentum Builder. You get 40% off of MBS Highway. You get really this is 33% off list reports, but we throw in Agent Intel and we throw in Agent Connect for you. So it's really a lot better deal than that. Home Report, like I said, HomeBot's $200 a month. You get Home Report at $89 a month. If you just email Diane at MBS Highway, if you want to hit the QR, but if you email Diane at MBS Highway, she'll walk you through, or she'll set you up with somebody to walk you through. Or if you just say, okay, let's get going with it, we can get going with a team. But I think we came in exactly on time. But I wanted to tell you guys that I'm happy to stick around if you guys have questions for me.
Barry, every time I see you make a presentation, there's all these nuanced changes. And I think it's super important that we listen to, because it does change daily. It does change weekly. There's different outlooks, different reports, different things we looked at, different tools. And what do they say? That the coach appears when the student is ready. So even though you could see the same thing 10 times, it hits you differently in a different time. And so I think the way you presented a lot of this today made things simple, and it made things really easy and easy to elaborate. And we the point that you made in the beginning, I used to make before, and I said, look, there's only two reasons that businesses fail. You don't have enough leads, or your conversion rate sucks. And when you identify that if your conversion rate sucks, if that's the problem you're having, it's because it's your trust score is your conversion ratio. So putting all that together made so much sense for me today. I hope it made sense for everybody that joined us. The tools in MBS Highway, I love them. The one that we didn't go over today that we get huge benefit from is the not the rent versus own, but the local report, the real estate report card.
Yes.
That thing is fantastic. I love looking at that and saying, hey, did you know that over the last 63 years, this area has performed at 5.63%? Do you think that's a long enough period of time for us to make an assumption that the market will continue to perform that way? And I love using that tool. I think that's one of the really good ones to give people the comfort that real estate is here to stay. And then I combine that and I said, don't bet against the champ, the slide that you have in Presentation Expressway. And I show that slide and I show the real estate report card. And then I combine that with, let's say the rent versus owner, like, do you see it all makes sense and it all aligns? So what are you waiting for?
Hey guys, I'm looking at some of the comments. So first of all, thank you. And also, somebody had a question here. Chris, yeah, we can certainly get you somebody to walk you through. If you just email Diana, she'll set you up with somebody to walk you through and help you get going with it. All the individual tools have little videos or tips too, but we're happy to do that. Yeah, please just let us know. Yeah, team. Anybody have any questions for me? I could stick around for 5 minutes or so. So any questions regarding the economy or anything that's on your mind, we'll talk. I love you guys. So want to
Paul,
make sure we try and answer your
Barry, the
questions.
one thing in case anybody doesn't jump there, I do want to address the fact that tariffs don't have to be inflationary.
Look,
Because that's everybody's out there saying, "Oh, Trump's tariffs are inflationary." I'm like, not
some
always.
some people play checkers, some people play chess. If Trump were to say that the tariffs are just a threat and I'm not going to implement them, it wouldn't carry much weight, right? So he says, "Hey, I can threaten you with tariffs. I can threaten you with tariffs, and I'm going to do it. I'm going to do it." And then if they comply, you don't do the tariff, right? So there's a I think that a lot of what has been proposed isn't going to come to fruition. I don't think that we're going to see um, an overabundance of tariff usage, but some tariffs can be effective for other purposes too. So would they be highly inflationary? I don't think so. I don't think so if we become more efficient.
Yeah, and I think in in the way I'm looking at this is you probably have a cut in government jobs, right? And so as you cut those government jobs, if the private sector doesn't step up and cover those jobs, then you're going to see the unemployment rate rise. And to be clear, an unemployment rate between 4 and 6% is a historical average that we've
That
lived
is.
with for a
That is.
very, very long time.
That is. It is.
Yeah.
Yes, you're correct. You're correct. Yeah. Whenever we get into these things, it's always, you want to try and walk a tightrope here, politically. People get very sensitive. I try and be sensitive to that. It's, um, I think that the main thing for all of us is to just be respectful, to just have a lot of love and get along, right? So,
Yeah. Yeah. Well, Barry, we love you. Thank you so much. Really, really appreciate your time.
you guys are great. God bless you guys, man. Thank you
And
so much.
and for those that don't know, I'm also a medical nerd, and I spend a lot of time on AI. You can upload your blood tests to AI engines. You can upload your DEXA scans to AI engines, and that's been really, really cool lately. So use the tools you have available to you, whether they're financial or just educational. You don't need to go to college these days to learn. Look at Barry became an expert in 9 months on cancer. I've spent a numerous amounts of hours in my quest to lose 80 pounds and get healthy over the last couple of years. And all that
Hey,
information.
you're looking really good, bro. I saw you in person. You're looking really good, man. God bless you.
Thanks.
Look
Yeah,
terrific.
this time it's different. It's been a focus on health and not a focus on weight loss, and that made life so much easier.
Wow, that's great.
Yeah.
Well, hey, guys, happy Thanksgiving. Sending you lots of love.
All right. Thank you,
Bye,
Barry.
everyone.
Really appreciate you. All right, gang. Thank you for hanging out an extra few minutes. And what do we have next week? We have Todd Duncan next week is going to be joining us. And he's got a very big announcement he wants to make for you. So please, please, please join us again next week. And thank you for being on the More Momentum webinars.